Right then, hello everyone, and just another update from us at the end of another week of trading. We'll have a quick flick across the calendar and we'll just have a talk about the different events that went on this week, and a pretty busy week on the economic calendar. And we will flick across to the charts then in a minute. First things first though, Monday, this inflation print out of the Eurozone was quite strong when you look at it. 9.9%, the year over year figure, certainly with the flash estimate. 9.9% was last month's figure. 10.2 is what we were expecting this month. As you can see, we actually came in 10.7, and that's a big increase in the rate of inflation. 0.8 from last month and a beat of 0.5%. Now that's got a bit lost during this week. Markets have not really reacted that too much, and yeah, when we flick across to the charts, it's not really something that people pay too much attention to. So we'll have to skip past that a little bit. Strangely, I mean, pretty high, a pretty big beat in inflation. It's not something you see too often. Beat on the CPI print like that, but that's what we saw, and markets have not reacted too much to it. So we'll have to skip on past that. We'll have to move on. A raft of central banks we've had out also this week as well. We've had the RBA out on Tuesday. Now again, not much to be seen there. Stuck to the script, the same script as last time, a 25 basis point hike. Forecast on trading economics is for 3.1. As we can see, potential for a 50 basis point hike in terms of their analysts, but in terms of market consensus was for a 25 basis point hike, and that is exactly what we ended up getting. 25 basis point, and a stuck to the script again, as I just said, showing a 25 basis point hike. They said they are going to need to continue to hike interest rates in order to cool down inflation, and they are going to remain data dependent going forward. It's a copy and paste from the last meeting. You can probably copy and paste this to their next meeting as well. So RBA just sticking to the script, continuing on with what they have already been doing. Now we'll flick back down to the Bank of England. We did at the Bank of England out yesterday as well. Consensus 3%, actual 3%, so a 75 basis point hike in terms of the Bank of England. Now we had a 7-2 vote split. 7-2 vote split, so 7 members of the MPC, the Monetary Policy Committee, voted for that 75 basis point hike. But we did have 2 dissenters, one for 50 basis points and the other for 25. So a little bit of dovishness from the couple of them, but on the whole of things, slightly, just sticking to the same script as the rest of them. 75 basis point hike. Now, what we did have an update out of the Bank of England was that we are expecting a recession in the UK, recession across the UK, which is what we knew already. Now, we previously were told that it was going to last the rest of last next year, but we've then been told from the Bank of England yesterday that that was going to extend into 2024, so H1 in 2024, which is first half of 2024, so an 18-month long recession, 18-month long negative growth in the UK is obviously not positive for the UK at all. So that's what we saw off that. Not really much of a market reaction off that. It's kind of turned around, cable has, but that's more of a dollar move today, but we will get onto that when we see the charts. Apart from that then, we had the Fed out on Wednesday. Now we did have a manufacturing PMI on Tuesday afternoon, 50.2 print, consensus for bang on 50, actual was 50.2. Now that shows a bit of stagnation, a bit lower, the lowest print in a while, going back a while in terms of the manufacturing PMI. So manufacturing sector expected to stagnate going forward, certainly into next month or into this month really. That's the October figure. And that shows a potential slowing down in the manufacturing sector of the economy. We did have a non-manufacturing PMI print, was a little bit lower than anticipated as well. And we'll come across to non-farm payrolls today. Non-farm payrolls today, a slightly strong figure. Consensus was for 200, actual 261. But the unemployment rate has ticked up 0.2% from last month, a 0.1% beat. You call that a beat on expectations. Obviously not positive as unemployment is ticking up, but that shows a slowdown in the manufacturing sector. It's increasing unemployment, which is a situation that the Fed are not going to want to continue to hike rates at 75 basis points much more than they have done on Wednesday. We'll see 75 basis point hike out of the Fed. That was initially met with a dovish reaction. Stocks went higher, initially, and the dollar went lower. But that was in reaction to potential for 50 basis point hike in December, slowing down the 75 basis point hikes that we've seen 4 times on the spin. That is 6 rate hikes on the spin out of the Fed, and that was the reaction that we first saw in reaction to the statement and the decision itself. We then come across to the press conference where Jerome Powell kind of poured cold water on that, slightly not cold water on it, but we are likely to see then a 50 basis point hike in December. But the terminal rate of the federal funds rate is now likely to be higher than what we were told back in September. We were told via the dot plot back in September of a 4.6% terminal rate for the federal funds rate. That is now likely to be higher. That's likely to be above 5%. They are now likely to slow the size of rate hikes, but maybe hike rates for a bit longer. So we are likely to see this above 5% before it stops in at some point over the first half of next year. And now that is really it for the calendar. We'll flick across to markets, and we've had pretty interesting day in terms of markets. Pretty strong risk sentiment over the course of today. Stocks have pulled back from the highs. At one point earlier on, the S&P was up 2.25%, and the Dow Jones, Nasdaq were up heavily as well. But we have seen pretty strong moves lower across the board in the dollar. We can see here the US dollar index, the DXY, the DXY, pushing then lower. In line with these kind of lower highs and lower lows, is a little bit rangy, but is still pulling back slightly. And we saw a big downward move in the dollar index over the course of today. Euro dollar up 150 pips, cable up 110 at the time of speaking, Kiwi up 110, Aussie up 140, dollar yen down 100, dollar Swiss down 140, dollar CAD down 200. Again, that move is slightly pulling back, but that's clear selling of the dollar on the session today, which does not go in line with the hawkish bias that we've seen from markets, or hawkish reaction from the Fed that we've seen across markets over the last 48 hours. These stocks now turning back into negative territory, which is interesting. We can see this candlestick here. If I just get a little measuring tool out, measure from the low of this candlestick up to the high, we can see then 2.3%, as we can see there, that we were higher up earlier on today, rejected off that 3,800 round number, and we have since pushed back 90 points from the highs. Now, we have clear risk on trading across the board. Earlier on today, we gold higher up, gold's up nearly $50 higher on the day. That was obviously in line with a weak dollar move. Oil was up over 4%, nearly $4 higher over the course of today. Again, slightly pulled back over the last kind of hour or two since that unemployment print. Flick across to the US 10-year yield, which is the chart we need to be focused on. We need to keep an eye on. Rejecting off this 4.2% at the moment, still higher on the day, still grinding higher, and that is the chart we need to look at in terms of direction into next week. This massive moves lower on the dollar. Those numbers are not something we see too often. But those numbers lower on the dollar, is that profit taking position squaring into the weekend, or is that selling of the dollar? A little bit difficult price action to read into. The reaction to the Fed was hawkish over the last 48 hours, but that move lower today in terms of the dollar is slightly difficult to wrap your head around if that is what if that's what we had on Wednesday. Now, our market's anticipating that they are approaching the end of their hiking cycle, that whenever that then comes, that is likely to be negative for the dollar, or not likely to be negative for the dollar, it will be negative for the dollar, and it will be positive for stocks. Stocks, though, with the interest rates up above 5%, be interesting to see how stocks perform in that environment into next year. We haven't seen interest rates at those levels since the 08 financial crisis. So we'll have to then see how that plays out into next year, and we'll have to wait and see for that one. But the price action today, a little bit tricky to wrap your head around. Be interesting to see how we close how we close this evening into the weekend, and then Monday we can look to try and wrap our heads around it a little bit more. But overall, still a positive week for the dollar still. But these moves lower, these moves lower and not what you would want to see if you wanted to buy some dollars off the back of the Fed earlier on. So again, as I said, this chart, the euro dollar chart, these dollar charts across the board will be interesting. Those stocks have certainly pulled back from the highs. Do we get another push higher into the close, or do we finish significantly lower than where we are now? Again, a bit difficult to wrap your head around, but we will see into next week what goes and happens. We'll flick across to the calendar into next week, and we do have a CPI print out of the US next week. Apart from that, not a great deal in terms of the calendar. GDP figures out of the UK showing we expected to see some negative growth in Q3, which will then be in line with what the Bank of England said, with a slowdown in the economy, increasing risks of a deep recession in the UK, and that is obviously likely to be negative for UK related assets. We do have this CPI print next Thursday out of the US, which will be the main focus of attention into next week. Not a great deal out on Monday, Tuesday, Wednesday, but that CPI print, the inflation rate itself, the CPI print, including food and energy, has pulled back for a couple of months. It's printed a couple of months lower. We're expecting now another month lower, so that's signaling a bit of a downtrend in that CPI print, including food and energy. Once you exclude food and energy and you look at that core CPI print, we are now expecting, or markets are expecting, this to pull back slightly and go back below the 6.6% we saw last month. Now, if that does happen, that is likely to be negative for the dollar and positive for stocks. That is likely to correlate with the Fed slowing down the pace of interest rate hikes. Once you look at unemployment rising this week, once you look at the manufacturing sector slowing this week, a weak CPI print next week is going to be negative for the dollar and will probably shoot stocks higher. So that's the play into next week. If that continues to happen. If we do get some positive closes today in terms of stocks, some negative closes in terms of the dollar, we will see a negative close in the dollar, you would imagine, but those stock markets into the close today, we've still got another few hours of trading, will be interesting into next week, but we will cross that bridge when it comes to it. So I'm going to wrap it up there then, folks. I'm going to let you get on with your evenings. Have a good weekend. Do recharge the batteries, and we'll speak to you again next week for another week of trading. Thank you.